an ugly environment like this one, and yeah, it's ugly, you need to become very good at distinguishing which stocks need to be avoided like the plague and which ones can be picked at as they go lower and become cheaper. Consider GameStop GME. That's the world's largest video game retailer and a stock that has been absolutely on fire until a month ago, thanks to fantastic numbers and the company's continued diversification into various different kinds of TV, movie, and game-related loot, not to mention phones. But then GameStop stock slammed into a retaining wall, shares falling 8% in a single session after the company reported back on August 27th. What was wrong with GameStop's results? Look, when you go through the actual quarter itself, the numbers were very strong. Nice top line and bottom line beat along with expanding margins. But the company gave guidance for the next quarter that was regarded by many as being disappointing. And that disappointment trumped the good news. However, with GameStop now down a little more than $7 from its high, sporting a 3.6% yield, although still up almost 20% for the year, we have to wonder if this guidance was truly worrisome or was management being conservative. Let's take a closer look with Paul Raines. He's the CEO of GameStop. He's coming from his new Think Geek store in Orlando. We got to hear more about that. Got to hear about more how the company's doing. Mr. Raines, welcome back to Mad Money.
Hey, Jim, it's great to be here. Thank you.
All right, Paul, you got to explain to me where you are, because I know a lot of people are betting against the stock, thinking all you are is a place to go get video games. Nobody does that anymore.
Right. It's unfortunate, but that's okay, because we believe in our story. Look, Jim, we've been around a long time. We're going to continue to be very successful. I mean, we comped 8% last quarter. That's not a bad number. Earnings per share were up 41%. And the story that nobody talks about is gross margin expanded 110 basis points. So our business is healthy. Would love to talk about any of the segments, but our business is very strong. And I think, unfortunately, some investors have chosen to flee, but they'll be back.
Okay, now let's talk about the idea of what you call loot, which is something that I didn't realize was very powerful. We're going into Star Wars, okay? Now, when I think Star Wars, I think lots of ancillary products. What does Think Geek, what does GameStop have for Star Wars as a good example?
Well, listen, Jim, we love loot. It's the collectibles category, or loot, as some of our team calls it. You know, that's a $20 billion category in the United States. So we've studied it and understand it. It's very exciting. What do we have? We've got a ton of Star Wars product. I hope you kept that Yoda I sent you. You know, I use it a lot. Here's the SKU you need, Jim, the BB-8 for this year. This is the kind of robot that you need for your business. But listen, it's an exciting category, and it's not just Star Wars. There are a multitude of SKUs, licensed collectible products in this store. This is a Think Geek store. You know, we made that acquisition in the spring of Think Geek. We think the collectibles business will be $200 to $250 million this year. Before Think Geek, we think it'll be $500 million by 2018. So it's exciting, and you can see behind me, there's a lot of customers in our store at the Florida Mall here in Orlando.
All right, now, Paul, can you tell me what this company is going to look like a few years from now? Because you've made a series of acquisitions. I think people still regard it as that store in the mall where you go in and you buy the Xbox, which, by the way, as you showed, is a really good business. But you've done a lot with telephones. You've done Apple. I need you to give people the full mosaic.
Sure. You know, Jim, what we are is a portfolio, a family of diversified technology brands that are making your favorite technology products simple and affordable. And the reason we call it that is because what we are trying to do is smooth out the cycles in video gaming. So we embarked on some acquisitions. You know, you brought out technology brands. That's our mobile and Apple division. You know, that business has gone from about 70 stores to about 730 stores in only 2 years. That'll be, you know, $1 of EPS by 2019, and it'll be $1.5 billion of revenue. So that's an exciting business. We are a diversified company in that we bring to the consumer a lot of common things. We bring excellent store execution, which is great service, great inventory management, great real estate. We bring a loyalty program, 40 million members of Power Up Rewards around the world. That's a great, compelling program that overlaps across the board. We have a buy-sell-trade business. We give you $1 billion of trade currency every year. We have disciplined capital allocation. So we have a lot of things that are very common across all of these retail formats. So what we're trying to do is bring you technology products in different ways that leverages our knowledge of specialty retail, both online, omni-channel, as well as in physical stores.
How did you get 40 million loyalty? I mean, the companies that have 14, 15 million are viewed as big success. How did you get that many?
You know, Jim, it's an interesting story, but we came here almost 10 years ago, and one of the things that we've identified is that video gamers at that time were a very clannish group that really likes to be with authentic video gamers in store. That's why we invest so much in education for our associates. We hit the market very hard with this launch of Power Up Rewards. And it's so compelling, so exciting that we were able to move very rapidly. Then we went to our international markets, and we've added about a third of that number internationally. So we've been very fortunate. It's been a very, very strong rollout. I'll tell you something else, Jim, that's exciting. If you think about ThinkGeek, that's the kind of business that people love. They have a very significant loyalty program of their own. Guess what? They overlap with about half of our customers. So now our mission is to promote to these customers at ThinkGeek and at GameStop products from the other markets. I had a guy come in today who'd driven from Fort Lauderdale to find one of these, I think this BB-8 that we've got in this store. That's a exciting, loyal customer. So we've got to find ways to serve them and be authentic to compete with our big box and online competitors, and it's working, Jim.
Well, one last question. You know, I thought the guidance was conservative. I don't want you to trump your own conference call, but you got Call of Duty, you got Star Wars, Fallout 4, Halo 5. I mean, things could get a little lucky, right? I mean, the idea that you were so downbeat on the call might be indeed eclipsed by how much good stuff is going to be coming out.
Well, there's a lot of good stuff coming, Jim, and the fourth quarter, we'll see what the fourth quarter guidance looks like. But I will tell you, as I said on the call, we've been told many times by investors, make sure you set targets you can hit. So we're going to do that. Now, that does not mean we can't drive hard and manage our business. I mean, an 8% comp overlapping last year's 22% comp, you got to believe those are pretty good numbers. And we'll continue to push forward, and I think we'll be happy in the fourth quarter as well.
And that's why I know you've been buying back stock. You've got great yield. Paul Raines, CEO of GameStop. Fantastic turnaround, sir. Thank you so much for coming on Mad Money.
Thank you, Jim. Take care.
All right, guys. Set up guidance to be sure that he can beat that guidance. That's what you want. This is a company, good dividend, good buyback. You know what? It's the opposite of what's going down, okay? Mad Money's back into it. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.